Hi friends and welcome to another video of Just Being Earners. In today's video, we'll be looking at whether should you be paying off your debts or investing the money. So regarding the debts that we are talking about here, we'll be looking at credit card debts. So taking a look at this information from DBS website regarding their credit card interest rate. So let's say if you were to use a credit card from DBS and if you don't make the full payment, then you'll be charged a prevailing rate of 26.8% per annum. And if you were to look at OCBC website, the interest rate for OCBC credit cards is 26.88% per annum. And then over to UOB website, the interest rate is at 25.9% per annum. So whether should you be paying off your credit card debts or looking to invest the money, and then the returns that you have that is invested is able to cover off the interest of this credit card, and at the same time it's also able to give you extra profit as well. So what we shall do is that we shall look at the market index, and then to see that if we were to put the money into the stock market, into the market index, and we put it there for 1 year, will it be able to give us a profit? So let's say we have here is the SPY. So let's say we use a 5 years period. So you'll start from 2015. So let's say invest at the beginning of 2015 to the end of 2016. You actually see that your investment returns is a negative 4%. And let's say if you start from 2016 to the end of 2017, your investment returns will be at 10.9%, which is still unable to overcome the 26% of the credit card interest rate. And let's say if you do from 2017 to 2018, you will be getting 24%, which is still below the credit card interest rate. And then if you do from beginning of 2018 to 2019, you'll be a negative 4%. And then if you do from beginning of 2019 to the end of 2020, it will be at 20%. This is still below. And then if you do from the beginning of 2020 to the end of 2020, your returns will be at 16%, which is still below. So now we shall move on to the Dow Jones Index. So we shall also start from 2015. We are using a 5 years range period. So at the beginning of 2015, you invest the money, and then your returns at the end of 2015 will be at negative 4%. And then if you were to do from the beginning of 2016 to the end of 2016, your returns will be 21%, which is still below the credit card interest rate. And we do from beginning of 2017 to end of 2017, it will be 30%, and you do get it. And this is only once out of the past 3 years so far. And we do the beginning of 2018 to the end of 2018, and you will be getting a negative 4%, which is still below the credit card interest rate. And then we do from beginning of 2019 to the end of 2020, and you will be getting 12%. And then and that's it for the Dow Jones Index. So far from this record, you can see that it's only 1 out of the 5 years where your returns of the investment is higher than the credit card interest rate. And next on, we shall move on to the NASDAQ. So for the NASDAQ itself, from 2015 to the end of 2015, you only make 0%. Then from 2016 to the end of 2017, you make 21%, which is still below. From 2017 all the way to 2018, you make 30%, and you do get it once so far. And from 2018 to the end of 2018, you'll be getting a negative 2%. And then for the beginning of 2019 to the end of 2019, you'll be getting 25%, which is break even if you were to use the money to invest compared to paying off your credit card interest rate. So as you can see, based on the check that we've done so far for the past 3 market index for the US, you can see that only 1 out of the 5 years have the returns from investing in the US market index is able to be the same or even greater than your credit card interest rate. So this goes to show that if you have a credit card debt and you have the interest rate that is at 26%, it's best that you pay off your credit card interest rate instead of investing the money. Because by paying off your credit card debt of 26%, you are making yourself having a guaranteed return of 26%. But on the other hand, if you were to invest your money into the market index or the stock market, there's no guarantee that the stock price that you are buying in will eventually be higher 1 year later. So by making sure that you are paying off your high interest debt first, you are putting yourself in a much favorable position and not having the burden of having a high interest behind you that is on the drag, and it may cause you to invest poorly in the future. So end of the day, always do make sure by paying off your high interest debt before you invest your money into the stock market. So hope you learned something new, and always do remember to make smarter financial decisions every day. Have a great day ahead, and bye bye.